Hello and welcome back to my channel. I am Christy Vann with VANNtastic Finances, and on this channel I teach velocity banking. Today we are going to be talking about the difference between a mortgage loan and a first lien HELOC, which is a revolving line of credit. And I am bringing on Anthony Rushing. He is going to be really going into detail about what the difference between the mortgage and the revolving line of credit, the HELOC, is, and why you can pay off a balance on a property in so much less time. We're talking decades. That's crazy to me when I think about, what this line of credit does for people when they want to invest in properties. It has been such a game changer for so many people. And Anthony, welcome. Thank you so much for joining us today.
Thank you, Christy. I am so excited to talk with you and sort of share about what a first lien HELOC is, how it works. Again, the difference between that and what a mortgage is. I think that's something that obviously to understand how to use it, how people are able to achieve pretty amazing results, you have to understand what it is. You have to
Right.
understand how it's different than a regular mortgage. So I'm excited to talk today about those differences so you know exactly what it is and what we're looking at in terms of how people end up using it. So yeah, I'm really excited. Thank you so much for having me on today.
It's my pleasure. Okay, so let's start with what is the difference between the mortgage and the first lien HELOC?
Okay, so a first lien HELOC, just to start, is different than a second lien HELOC. And so I know that isn't what you asked, but I want to make sure that we know how it's different than a second lien HELOC, and then we can go into the differences between a first lien HELOC if that's okay. So a second lien HELOC, or a regular HELOC when we're talking about it, is where you keep your mortgage, you've got your mortgage, and you open up this line of credit on top of your mortgage. And so at that point, you have two different loans that have liens on your house. You have your mortgage, which is in the first lien position, and you have your HELOC on top of it. That's the way I like to think of it, in the second lien position. And all that means is, in the case that someone were to default, the first lien position loan gets paid off first. And then if there's money left over after that happens, the second lien HELOC, the second lien position loan gets paid off second. So that's what the lien position means. So a first lien HELOC is different than a second lien HELOC in that it doesn't open up a line of credit on top of your mortgage. What it does is it comes in and it essentially replaces your mortgage. It pays it off. It's a refinance into one big HELOC. Now, this HELOC is this HELOC is an open-ended line of credit. And so we'll kind of go into that too, because that's another way that it's different than an amortized mortgage. But in terms of what we're looking at, this is not something that opens up a line of credit on top of your mortgage and you still have your mortgage. It is a situation where it comes in and fully pays off the mortgage. It refinances you out of that and you end up with one big HELOC. So now, what is a first lien HELOC when you have it in that first lien position? When it pays off your mortgage, what are the differences between this and a mortgage? Well, like any line of credit, it has a limit and it has a balance. So for one, when it pays off your mortgage, you're going to have a line of credit with a limit and a balance. The limit is established by certain factors, the loan to value in terms of when you're doing the loan process, and the debt to income as well. That's what creates the limit. That's the max that you can go to with this line of credit. Your balance is established by paying off the mortgage. It's by your mortgage balance and anything else that you want to loop in as well. So it's important to know like that when you get a first lien HELOC, you have a limit, which a lot of times is higher than the balance. And then your balance is established by whatever you pay off. So that's one main difference. Now, in terms of how they work, the way I like to explain it or think about it is that a first lien HELOC, it's still kind of a mortgage product because it is a loan that the bank gives you that is secured by your real estate. That's kind of one of the definitions of a mortgage is you have a lien on your property and bank lends money. So it's still kind of a mortgage, but it functions. It follows different rules than an amortized mortgage does. And so amortized mortgage is just kind of the traditional mortgage that everybody has. And so with an amortized mortgage, it follows different rules again. And so there are two main ways that they differ. One has to do with money flow. The other one has to do with how interest is calculated. So if we think about money flow, for instance, with your amortized mortgage, money can flow in only. It's called a closed-ended loan. And what that means is every dollar you put toward it, everything that you use to pay down that balance is locked away, and you can never take it back out as long as that mortgage is active. A first lien HELOC, in terms of money flow, is different. Money can flow in and out freely. It's called an open-ended loan. And what that means is everything you put toward it to pay it down, you can take back out if you want. Well, when you take it back out, balance goes back up. But it's one of the main differences. So that means you can treat it differently because it follows a different rule set. Another way that it's different is that in terms of interest calculation, that's the second way that they differ. The amortized mortgage calculates interest by first looking at the previous month's end balance. So it looks at the last month, the last day of last month, and it uses that balance on that day against your interest rate to calculate your payment. And that's just the calculation. There's nothing bad with it. There's nothing wrong with it. That's just how it's done. A first lien HELOC or the right first lien HELOC is going to use a different calculation to calculate the interest. So the right first lien HELOC is going to use the average daily principal balance to calculate your interest payment for the month. So what that means, it's going to look at, you've got a bunch of days with a bunch of different balances throughout the month. So it's going to look at all those days' balances and take the average of all those balances. And it's going to use that monthly average balance against your interest, it's going to use that monthly average balance against your rate to calculate your payment. So knowing that, what we do is we take the fact that we know that a first lien HELOC works differently than an amortized mortgage. It follows different rules. And because it follows different rules, that means we can treat it differently to create different results that can be absolutely amazing. So in terms of the main differences between an amortized mortgage and a HELOC, comes down to two things. One is money flow. First, in HELOC, money can go in and out freely. And the second is interest calculation, because the HELOC calculates interest using the average balance of the month, not the previous month's end balance. So in terms of the differences, we have to understand those differences first before we can know how to treat the loan or what to do with it to make it perform in an amazing way.
And you're talking about the difference in paying a property balance of, you're talking decades.
You're talking cut it in half or cut it by 2/3.
Yeah.
The average pay down that we see for our portfolio tracks to about an 8 to 9 year average payoff for our average customer. So when this works, they've either paid off the house already, or they're tracking to an average of an 8 or 9 year payoff as compared to a 30-year payoff with an amortized mortgage. Like, these are the results that we see.
That is amazing. And, people don't believe that's possible until they see their actual numbers run. And
They really don't.
You have a calculator that will take their numbers and show them what that payoff looks like.
Absolutely. We have a calculator that people can run, and it will simulate the strategy. It'll simulate, if you were to implement the strategy using a first lien HELOC, what would the payoff time look like? And I love that, because I'm not bashful to say this. I'm in a sales position, we'll call it, but I really stink at sales. I stink at selling things. And so I'm not a natural salesman, but I don't have to be, because the numbers prove whether it's a good idea and the numbers prove whether it's not. And so we have no obligation to try and convince someone to get it if it doesn't make sense, because the numbers prove it out.
Right.
We actually have an obligation to tell people it doesn't make sense when the numbers don't work. And I like that even more, because I can go to bed, I can go to sleep at night and not worry one bit about helping someone on a path that's going to be good for them or not good for them.
Absolutely. And, I run basic numbers here with people every day. And if they have cash flow, I mean, it's almost always going to be an excellent idea. But what are the qualifiers for being able to do this application?
Yep. So you're going to want to have above a 680 credit score. Um, you're going to want to you want to have at least 10% equity in the home. So what I mean by that is if your home is worth $300,000, you need for the balance to be 90% or less of that. So in this scenario, if the home is worth 300,000, the balance really should be 270 or less, because I can't do a loan for more than 90% of the value of the house.
Okay.
The states that we can work in, I can work in all states except for Texas, Hawaii, Alaska, and Maryland right now. It's going to sound like I can't do this, I can't do this. Just want to make sure that as people hear this and move forward, that you're not surprised, later on if there's a hard stop. I can't do manufactured homes, I can't do mobile homes, I can't do modular homes. So those are just kind of a few general, a few general guidelines. If there's a bankruptcy or foreclosure, we need a 4-year period from when that happened. Let's see, what are some others?
Do you do tiny homes?
So when the home is really unique, like a geothermal home, right, or even like a log cabin, it makes it
Mhm.
really tough for us to do those, mainly because it's hard to get appraisals for those.
Okay.
For tiny homes, I know they kind of have their own definition. I don't have anything that says I can't do tiny homes in the guidelines, but it does say very unique type homes I can't do. With an exception, we could probably get it done. But I do, from what I understand, tiny homes kind of have their own little niche, and people either focus on tiny homes or they don't. So I wish I could give you a better answer, Christy. But
Well,
I will look and find. We'll look it up, and I'll and on the video in the comments below, I'll be sure to include that later on once I get the answer.
okay. All right. So you mentioned the credit score. And, when we talk about these HELOCs, people get a wrong idea about a HELOC. A lot of people are afraid of the HELOC compared to the mortgage.
They
So
are.
what do you think that why are they have that nervous feeling in their stomach when you talk about getting a HELOC on the property?